All right, good morning, good morning. And we are going to jump in and get started on our new course, Advanced Principles of Real Estate Investing. I'm going to spend just a little bit of time here in the intro and go over a little bit about what you can expect from this course and sort of map out the outline and how we're going to go forward. We'll be doing a new lesson every other Saturday. Today's the first lesson of this second course, the Advanced Principles of Real Estate Investing. And the way this course is set up is there are 5 lesson plans that are designed to illustrate each of the 5 investment objectives, which I'll go through and cover in just a moment. There's an additional 3 lesson plans that are designed to illustrate implementing the various investment objectives. And then each lesson will have anywhere from 1 to 3 exercises. And we have 1 exercise for today in the first lesson. So the course is the Advanced Principles of Real Estate Investing. It has 8 lessons. And each lesson will have 1 to 3 exercises. As we build each lesson every other week on Saturday morning, we will continue to add those to your back office so that you have all of that, including the recording of the actual lesson that we're doing like today. So let's talk a little bit about the investment objectives. This is really, I think, where a lot of investors miss the boat. And while they might be somewhat moderately successful financially, they could be so much more financially successful just by implementing a discipline and having some of this stuff in place with respect to their real estate investment portfolio. By the end of this course, you should be able to understand and implement strategies for achieving passive income investing in real estate. You should be able to describe and apply capital growth strategies and its impact on your investment decisions. You should be able to apply asset diversification techniques that allow you to manage risk in a particular real estate investment. You should be able to develop effective strategies that allow you to do real estate investing for wealth preservation. And lastly, you should be able to identify methods that allow you to implement strategies for wealth accumulation and apply them in real estate investing. Each of these 5 real estate investing objectives have a unique set of financial and tax attributes. And that's really where we're going to spend a lot of the time building out our understanding of how they work and how to evaluate an investment opportunity and how to evaluate your investment performance. Again, I'm no fan of single family because they don't cash flow. Return on equity, return on capital are very limited. And even if you're buying for cash with no financing and flipping the property, it's not the highest and best use of capital in terms of what you could do in a 2 to 10 unit multifamily. If you had 3 months of vacancy in a single family, at the end of the year, you have nearly a 30% vacancy rate. If you had a 5 unit and 1 unit was vacant for 3 months, you have a vacancy rate that's a fraction of what that is. So this affects your return on capital and influences the numbers and your investments. And that's why I'm just not a big fan of investing in real estate for single family. They just don't cash flow well and they don't perform. Let me just take a moment and just go through and highlight a little bit of the exercise. And sort of go through this particular exercise because this is something you should come back to and refer to on a regular basis. The first step is the three primary objectives in real estate investing. One is for each property that you own, do you have a defined investment objective for that property? Second, can you identify and write down the financial gain and the tax-free income that that property generated? And third, do you have a defined exit strategy? Are you going to sell it? Are you going to 1031 it? If you're going to sell it, do you have a gains mitigation plan to mitigate or reduce the exposure to capital gains tax? These are things that are critically, this is so important. This is like the three-legged stool to real estate investing, these three defined objectives. Almost every investor misses the full financial benefit of a property simply because they don't have these primary objectives ever defined or clarified. Again, the 5 financial objectives in real estate investing: achieving passive income. You can have a property that is the specific investment objective for that property, passive income. You know, another property where the investment objective is capital growth. You can have another property where the objective is asset diversification. You can have another property where the objective is wealth preservation, and yet another property where the objective is wealth accumulation. Your entire portfolio of all properties can be governed through these investment objectives. The point that I'm trying to make here is if you don't have an investment objective before you buy the property, you're certainly not going to have one when you sell the property. And because of that, you're very likely going to underperform and not make the kind of money or profit that you could have otherwise made, but for the fact that you did not have any of this defined. Every piece of real estate that you invest in, every real estate investment should have a financial economic performance that you define. It has to meet certain financial objectives. If it can't meet those objectives, then don't buy it. That's just, it's not complicated. But if you don't know what those formulas are, or if you don't know how to apply the formulas and do that analysis, then you're not investing. You're just guessing, and you're using a lot of money to play a guessing game and hope that it works out. Every real estate investment should have a property pro forma. There are 6 components that make up a property pro forma. First, you have to identify the subject property. Then you have to classify it. Is it single family? Is it multifamily? Is it mixed use? Is it commercial? It has to be classified by its investment type. Then you have to classify and segregate that property into asset groups. You have land and building. On the land, you have improvements on the land. Things like driveways, sidewalks, irrigation, sprinklers, bushes, shrubs, trees, fences. These are depreciable assets that are improvements to the land, and they have a scheduled classification asset life of 15 years. Then you need to conduct a rent survey, not a rent comparison. Rent comps are not reliable, and they're not to be used for your investment analysis. They're just not reliable. A rent survey is a detailed approach on understanding the methodology of how you're going to determine rents and how you're going to manage the income as it grows year over year on a sustainable long-term basis. Number 5, you create the pro forma analysis and reflect in that analysis a 3, 5, 7, and 10-year holding period. You want to know at each of these standpoints, what are the financial and tax attributes? Are they diminishing over time, or are you gaining momentum because of surplus cash flow and building equity? Your return on capital is a different number in analysis than your return on equity. And if you can't calculate that, you don't know if you're making money or not. And you can't make a decision about the disposition or the sale of the property because you don't know what your gains exposure is going to look like. That takes us to number 6, identify and mitigate the capital gains exposure. This is the biggest area where you could lose the most amount of money. You think you made $100,000 in profit, but actually you made about $60,000 in profit because you didn't factor the capital gains tax, the income tax, or any other of those financial attributes that are going to take away from your ability to retain or keep any of that money as profit. So the pro forma process as an investor allows you to step up your game and lean in, not from an amateur standpoint, but as a professional, sophisticated investor. This will provide you with significant reduction in risk, allow you to do better risk management, while at the same time identify financial and tax attributes that will increase your return on investment, your internal return on investment, your yield on the investment, your return on equity, and your return on capital. Lastly, the process can save you tens of thousands of dollars in capital gains tax on any future disposition because you've identified the gains traps that can be mitigated during the holding period of the property. So that's really what I'd like you to do for the first exercise, is go through each property that you have and sort of outline it on a single sheet of paper. Do you have these things? And what are your investment objectives for that property? And do you have an understanding of the asset groups of the property? Property tax is not the same as income tax or capital gains tax. So your property tax statement is not a reliable source for you to take the approach and figure out how much allocation to land, how much allocation to building, and how much allocation to the improvements on the land. It's not reliable. It's only reliable for the purposes of the imposition and assessment of property taxes, which is very different than capital gains or income taxes. So back to our lesson and our course objectives. This is really what this course is designed to provide. Again, 5 lesson plans designed to illustrate each of the 5 investment objectives, and an additional 3 lesson plans designed to illustrate implementing the various investment objectives. Each lesson will have between 1 to 3 exercises. And we will do 1 lesson every other Saturday, starting today with lesson 1 in this course, this course is an advanced course, the Advanced Principles of Real Estate Investing. All right, let's move on. By the end of the lesson, you should be able to explain what passive income is and its importance in real estate investing. You should be able to identify and implement basic strategies for achieving passive income. You should be able to analyze a real-world example of successful passive income investing or investments. And you should be able to have and conduct a discussion and apply passive income strategies to your own investment plans or your own investment strategies. You have a real estate portfolio that makes up all of your real estate holdings, including your personal primary residence. If it's real estate, it's in your real estate portfolio. The question I have is by what measure and by what amount as a percentage of growth, how much is your portfolio growing each year in value? How much equity are you growing in equity every year in your portfolio? And you take those numbers and you compare that to the rate of inflation, and you should be outperforming the rate of inflation. Otherwise, you're going to be losing money and you're going to be losing value. Some suggestions that I'm going to give for you beyond even this course. These are activities for every investor. Study the principles of investing. Study investment objectives in real estate investing. Study the investment formulas. There's hundreds. You're going to need about 20. Review different examples or case studies or examples of passive income versus capital growth strategies. And review real estate investment analysis tools, things that allow you to analyze a piece of real estate from both a financial as well as a tax perspective, pre-tax, post-tax. These are the things that will allow you to up your game and actually get into the ranks of a sophisticated investor, because your focus is on growing your capital, preserving your capital, growing your portfolio, and do that while at the same time managing and mitigating risk. And one of the biggest risks that you have financially is your tax exposure. Maybe not today, but you're certainly going to have a lot of it when you get ready to dispose of the asset on a sale or some other disposition like a transfer or a 1031. You're going to have a day that reckons that out. And if you don't have a plan for that, then you're going to pay the highest amount of tax subject to both the income tax as well as the capital gains tax. Oh, let me go back here. Studying these principles, let me just tell you something that one of my mentors shared with me many, many years ago. Let's say you have a job and you work 40 hours a week. That's 2,080 hours a year. You got 24 hours in a day, 365 days a year. So you got a little over 6,000 hours in a year. Time is money. So my question is, how are you spending your time? Because it's usually a good reflection of how you spend your money. If you don't tell your money where to go, it's liable to go anywhere. And that's the challenge, is what are we doing with our time? If you were to allocate and spend 100 hours studying a subject, you would probably know more than 90% of the people that you know about that particular subject. And that's only 100 hours. That's less than 2 hours a week allocated and devoted to studying real estate investing. You would know more than 90% of the people that you know about real estate investing. If you're not studying and you're not learning and you're not looking and trying different approaches, you're just guessing. That's an amateur, and that's okay, but that's not a sophisticated investor. You're not investing. You're putting money into something and hoping that it's going to work out, but you don't have any defined objective, no investment objective that's guiding you. These are disciplines that allow you to manage risk and allow you to have your assets perform for their highest and best use and optimizing your profit. If you're not mitigating your taxes, you are not optimizing your profit, because you're going to pay a lot of tax because you don't have a plan. And that's the whole point. That's less than 2 hours a week. So just to get us started, I'm going to talk a little bit about passive income, and I'm going to talk a little bit about passive income in real estate and these different characteristics that relate to real estate passive income. From a tax standpoint, all real estate is defaulted and presumed to be passive unless and except it meets some exception to that general passive activity loss limitation rule, what we call PAL, PALL, passive activity loss limitation. You can see a tax guide in your back office for the passive activity loss limitation standards. If you are not actively and materially engaged in the management function of the property, then it is a passive activity. And your investment in that real estate is passive. Losses in passive activities can only offset passive income. You have $1,000 of passive income from interest on a savings account, and you have $1,000 of passive losses in your real estate. You have no taxable income because one offsets the other. Up to $3,000. Anything over that is suspended, and those losses are carried forward to future years for as long as you live. Passive income is fine. But I hear a lot of people, especially in network marketing, saying that they're trying to develop all of these different passive income approaches. That's the worst thing that you can do in your accumulation years is create a bunch of passive income. They're using a term, not understanding what the term really means. It's a term of art because passive income has a lot of restrictions to it. I want ordinary income because ordinary losses offset ordinary income. Wages and salaries are ordinary income, and wages and salary get taxed more than any other kind of income. So it's not you that's getting taxed, it's the type of income and its character that's deciding the kind of tax. And then the entity structure is deciding the type of tax. If you're doing it as a single investor or sole proprietor, then you're electing to be taxed at the highest possible rate. If, on the other hand, you have a management corporation as a conduit to an LLC, and the LLC owns the real estate, you're probably not paying any tax if it's set up the right way. This is all in how you set up your investment and its character and the property's character and your tax character. Every sophisticated investor, this is what they focus on. A good example of passive income is T-bills, treasuries, CDs, interest on a savings account. These are all passive income sources. You can also have passive income in a real estate investment. You can be a limited partner in a limited partnership. You can buy interest in an REIT, a real estate investment trust. You can buy shares of stock that own real estate on the open market. These are all passive. You can have a rental property, and then if your rental property is being managed by a property manager, then it's never going to be ordinary. It's always going to be passive because you're not actively and materially engaged in the management function of the real estate. You don't meet the standard for it to be ordinary. The danger and the risk of passive income is that it is very narrow in terms of what you can do to plan. If you're going to have real estate investing and you want to harvest the tax benefits and the tax attributes aggressively through cost segregation, depreciation, and those types of strategies, then the last thing I want is a bunch of passive income because my losses are going to be limited to $3,000 a year. I want it to be ordinary, so I want my activity to be ordinary. because I'm going to need those losses to offset other ordinary income so that I can literally make $1 million, but I have $1 million in ordinary losses that are going to offset that. And I have no taxable income. I have money and I have income, but it ain't taxable. And that's because setting up the structure, the entity structure, and the character of the investment is controlling that. Passive income is a common objective for real estate investors generally that are going pre-retirement to retirement. They just want the return and that income stream, and that's fine. But that's a whole different kettle of fish and a whole different investment objective than going out looking and tracking down the property, making the offer, going through escrow, getting the rehab done, getting the repairs done, renting it out, collecting the rents, all of those things, very different than just getting the check every month. Some of the benefits to passive income is some of those investments provide steady, sustainable cash flow and can give you financial independence. At some point in the future, I've got clients that are in retirement in their 70s and 80s, making $10,000, $15,000 a month on investments, some portion of which comes from real estate activities that are passive. And that's fine. They've spent their life building that. It gives you some stability in the portfolio, and there are a few tax benefits that can be used in terms of setting up trust and other things for wealth accumulation and wealth building. So there's certainly a lot of room in anybody's portfolio for passive income. My point, and the thing that you want to do, is make sure that your investment objectives are in line with your property, or your property's in line with your investment objectives. If you have 5 properties, you should go through this analysis for each property, because those properties make up your entirety of your real estate portfolio. And you want to know at the end of the day and at the end of the year, how did your portfolio perform? Who were the winners and the losers? What were the laggards? What were the ones that outperformed the others? These are the things that are going to allow you to measure your financial success. Strategies for achieving passive income are not complicated. There are all kinds of investment opportunities: residential, commercial, vacation rentals. Properties can be through limited partnerships, limited LLPs. You can invest in a variety of different instruments and vehicles that will allow you to be an investor in a rental property and configure it in different ways. Real Estate Investment Trust. We, in 2022 and 2023, Susan and I invested in some REITs that did very good, outperformed the market, 10, 12% returns. And then toward the end of 23, when we saw this shift in real estate coming, we got out of those. And I'm glad that we did, because now they're down about 15%, and they're going to continue to go down. REITs are real estate investment trusts that are traded on the open market on the stock exchange. You can buy shares in them, and you get an interest in that. You might get a dividend, and the dividends might be greater than the return on the investment or the shares of stock that you have. But they're classic investment vehicles. Some of them outperform the market. They're a little bit more aggressive. And oftentimes they're used to balance a portfolio in retirement, in the years of retirement. There are a tremendous number of crowdfunding platforms that also allow for real estate crowdfunding, and they all work about the same. You put money into a crowdfunding, you go into a project or a property, and you participate in an allocation depending on a fixed amount or an allocation of percentage, and that's where you get your return, pre-tax. Remember, that's all going to be taxable income, passive income. There are some advantages to using crowdfunding platforms because there's less paperwork, but you want to make sure that it's anchored and founded in the operated in the US, and then it's properly registered. You can get into issues that deal with securities laws. So you want to be careful in understanding the kind of crowdfunding platform that you're in. There's some other forms of passive income in real estate. I did a couple of projects back 30 years ago, a couple of limited partnerships where we acquired some vacant lots and built duplexes. We had a template for this particular 3-bedroom, 2-bath duplex, 2-car garage, and we built a couple of those. The investors that put up the money, I had enough money to buy the land for cash and build the construction cost for cash. And then once it was done, we'd put it on the market and sell it with a couple of tenants already in it. And during that time, it was a very, very lucrative way to get into real estate. It was most of those were either 70-30 or 60-40 deals. The investors got 70%, I took 30, or they got 60% and I took 40. Those are not as common because you see LLCs have, back in those days, we didn't even have LLCs. We had limited partnerships. But now that LLCs have become a popular investment vehicle, it's generally, you see them on larger deals like 20, 30, 40 unit buildings or developments. We're working with somebody right now on a 20 unit project in Texas and setting up an entire platform for how they're going to do this. And they're going to hold it for 5 to 7 years and sell it. If they do it the right way, they'll save $4 million in tax. If they do it the way that they're planning on doing it, they're not going to save $4 million in tax. They'll pay an extra $3 million in tax. So when you're starting to talk about a $20 million project that's going to be worth $30 million in 5 years, and you're going to have to give 5 or 6 million of that up in taxes, that's a big deal. When, if they do it the way that we're suggesting, that $30 million that they're going to get, they're only going to have about $1 million in tax. It's going to save them about $4 to $5 million. And so those are the kinds of opportunities that oftentimes you can go into where the minimum buy-in is maybe 100,000 or 50,000. There's plenty of those opportunities out there. My point is all of those fall in the bucket of passive income. Because again, you're not actively materially participating in the day-to-day operations and management of the property. Passive income analysis is pretty straightforward. Whatever the rate of inflation is, your return, pre and post tax, needs to be 3% above the rate of inflation, or it's not going to make sense for you to invest. So you've got to really understand what the rate of inflation is, and you've got to understand what the rate of return on the investment is. And if you're not outpacing that pre-tax and post-tax by 3%, not probably a good idea for best use of your capital. The higher the percentage of return on a passive investment, the more risk you're taking on. If you're investing in a real estate development deal or a real estate flip or whatever as a passive investor, this telling you that it's got a 20% rate of return, what I'm going to tell you, it's got a lot of risk built into it. 20% return on a real estate investment is probably inherently very risky. So understand the risk and understand your risk tolerance. There are a couple of tools that you can use to understand and take these little surveys, and it will tell you what your risk tolerance really is, especially in real estate. A lot of people don't really understand what their risk tolerance really is. And so they just go invest, but most of that investment is driven by their emotion, not by any analytics or any numbers. It's just because they like the yellow kitchen and it looks good on the curb. That's not a basis for investing in real estate. Detailed case studies, we're going to provide a couple of those over the course, and we'll discuss investment strategies and outcomes. Basically, the strategy is that your investment has to have a return on investment that you can measure before you get taxed and after you get taxed. That's the bottom line. What is your pre-tax return and post-tax return? In other words, what's your return on that investment before you have to put it on your tax return and pay tax? And then what is your return on that same investment after you put it on your tax return and paid your tax? If it's not performing within a defined measure of metric that you've established as your objective, then it's probably not a suitable investment or a good use of your capital to invest in. Again, this is why I don't like single family residences for a real estate investment, because they don't cash flow. The vacancy factors don't apply the same way as multifamily. The inherent tying up of capital in a single family limits my ability to take that same capital and put it into a duplex or an 8-unit and leverage that and get the tax benefits while I don't have as much capital at risk. So return on equity, return on capital, all of these factors go into my analysis. And we've got sort of a sweet spot. We like 4 to 10 units, Susan and I. We like 4 to 10 units. That's the sweet spot where we figure that you can really do surprisingly well in harvesting the tax benefits and the financial attributes and tax attributes in a 4 to 10 unit building much more efficiently than you can in smaller units. Duplexes and 3 units are probably okay. But above 10 units, you've got other, particularly here in California, if you have 12 units or more, you have to have an on-site manager. What that means is you have a new employee. So you got to pay a salary. You got to give them a place to live. You got to pay employment taxes and the risk and workers' comp and all of the nonsense. No, I don't want that. Those are reserved for those big management companies that have a lot more cushion financially to absorb those kinds of risks. I don't want to take on that much risk. What I would encourage you to do between now and our next lesson in 2 weeks is create an outline on your investment portfolio and what your investment strategy and what your investment objectives are. And that's the general overview that applies to your real estate portfolio. And then take that same approach for each property that you have and just get a single sheet of paper on a notepad like this, just a regular notepad, and a single sheet of paper for each property, and do the same exercise for each property. What it's going to reveal is probably you've got a little bit more homework to do in terms of really synthesizing down those investment objectives and creating that basis that's going to allow you to measure the financial performance on each property as part of the whole, and then on the portfolio combined. How would you incorporate passive income strategies into your own investment strategies? Is there room in your financial life where passive real estate investing makes sense? Right now, for Susan and I, not on the horizon for us right now. For the next 3 to 5 years, we're still very much into the accumulation and building stage. We've got 2 more objectives. We're going to buy 2 more properties that are going to be 8 to 10 units each. We're going to pay cash for those properties, and then all of that will be consolidated in realigning our portfolio in the next 3 to 5 years, so that it is all in the income side of it, because that's going to be the wealth preservation and accumulation and growth stage of our portfolio. but it took us about 8 to 10 years to get it up to where it is right now. And fortunately, we can take that next step, and well thought out and well planned. This is what I'm seeing. $1 portfolio, without taking on more risk than what is absolutely acceptable or necessary. Also, if you have ideas and strategies for each property, what were your strategies? Write that down at the bottom of each page, because your strategy may need to be reviewed in terms of the bigger picture. That being, do you have the entity structure that is going to enhance your ability to accumulate and preserve not only your capital, but your gains? And do each of these properties meet those financial objectives? If not, are there things that we can do to mitigate or improve their performance? How do you decide what the rent for a particular property should be? If you're using rent comparisons and just figuring that you're looking at apartment.com and what they're charging the guy down the street or the gal across the way, that's a race to the bottom, because they may be discounting and trying to get the cheapest rent, or they may not have raised rents in the last 5 years. You don't know. There is a scientific and mathematical formula. This is why we do rent surveys, because it allows for a discipline to be applied that eliminates the emotion. And I don't want to have a lot of emotion in real estate. It's really about, at the end of the day, it's a profitable investment or it's not. And if it's not, I've got to find out why. These are the things that are going to give you the ability and the opportunity to have a discussion or look at the feasibility of your strategies, and maybe it's time to refine your strategies. The next 12 to 24 months, we're going to see a major shakeup in the real estate sector, particularly in commercial and single family. Conversely, we're going to see an entire reshaping and growth opportunity for multifamily, especially 2 to 10 units. It's going to be just unprecedented what's happening right now. I give it about no more than 24 months, and we're going to see a very different real estate industry. A lot of this is going to be driven by the economic factors that are going on right now with the Fed and interest rates, but a lot of it is the economy has radically changed. And so we're seeing the early signs of that, and we're going to see this shift. You have 80 million boomers that are sitting on $65 trillion of real estate that's going to be coming into the market in the next 15 years. That is going to have a radical transformation of the entire real estate industry. Those children and grandchildren that are going to be inheriting a good part of that $65 trillion of wealth have no clue what to do, and they're probably going to, for the most part, most of them, sell it. That's going to open up huge opportunities, particularly for those boomers that have 4 units, 5 units, 6-unit investment properties that are going to go on the market and are going to be discounted in ways that you can't even imagine. It's just going to be phenomenal, the opportunities that are going to be present. So I would be looking at today and on the horizon for the next 3 to 5 years as one of the greatest opportunities in real estate investing that I've seen in my lifetime. I mean, it really, I wish I had another 50 years to play this game. It would be great. All right, let me just give you some key points as we kind of go to the closing part here. Some of the importance of understanding passive income is it's got to meet your financial objectives, and it's got to be complementary to your tax objectives. If you don't have that defined, you should work on that, because that's the biggest area that you have the highest amount of risk that you can actually do something about to control. Some of those strategies Maybe you have one of your properties or two or three of your properties that are cash flowing sufficiently where you can build reserves and take that and put it into 30-day CDs. You know, when we bought Mohawk 5 years ago, it was GSI, the gross scheduled income was 70 grand. It's now almost at 135 years later. All of that surplus cash flow built up, rolled it over in 30-day CDs, and every year we did a big chunk and paid down the debt. We almost own that property free and clear. It's now in the 5 to 7 year holding period where we bought it for $979. We're gonna sell it for 2.2, 2.3 million with no debt. And we're gonna take that, add it to the other, and buy a 7 to 8, maybe 10 unit building for cash and get 5 times the return. And no taxable income because the structure is set up. This is the kind of planning that I help clients formulate multi-million-dollar transactions when 10 years ago they were just starting, and they built a multi-million-dollar portfolio primarily because the tax savings and the financial attributes help them finance that. Understand what your strategies are for passive income. If it makes sense, then make sure that your risk tolerance is complementary and make sure that you're measuring pre-tax and post-tax what your returns are. Otherwise, you're going to be losing money. Some glossary of terms that you should look up and understand is passive income, rental property, real estate investment trust, crowdfunding. Study those terms, understand what they mean and how they work. So just as an idea for maybe an assignment is take the exercise 1, which you should have access to in this morning's email or in your back office. Take that approach to your entire portfolio of all your real estate holdings and make sure your primary principal residence is included in that. And then do that same outline for each property. And then look at your passive income investing strategies. What kinds of passive income do you have, and what are your strategies? These are the things that are going to define whether or not you have a clear, defined objective when you invest. If you don't have a clear, defined objective when you invest, you should be working to at least understand how to develop that so that before you make the investment, you know that the investment under consideration is going to meet that objective. Doesn't matter what the kitchen looks like. Doesn't matter what the front yard. Doesn't matter that I have a big backyard. Doesn't matter. What matters is, does it perform and meet the financial objectives that I have defined for the purpose of investing and risking my capital? If it does, then good, we make an offer. If it doesn't, we move on to the next one, and we keep doing that until we find one that does. Let me give you a little bit of a heads up on lesson 2 in 2 weeks. The capital growth objective, which is one that we just executed on our Periosea project. This is a very, very, very powerful investment objective. When your objective is capital growth, man, are there some cool things that you can do. And every one of them you can do and not have any tax exposure or very, very, very little tax exposure. I love capital growth objectives because they allow me to get very good returns on the capital and pay very little tax along the way. And the rates of return and the yield on the capital and on the investment are just, when you factor in the tax attributes, it's just staggering what you can do. So we're going to have a lot of fun with capital growth objectives in that lesson. Capital growth is I take $100,000 and I grow it in a finite period of time to 200,000. How much is my risk? What is my investment strategy? And how am I going to do that? And so we're going to walk you through how to do or how to perform or outline a capital growth objective in real estate. The long-term benefits is that it gives you capital appreciation at the same time that it gives you the economic value that when you make a disposition and sell that property, you've already got the tax strategies in place that you're not going to have any tax exposure. You've already managed that. When you add the tax savings back to your return on investment, a 9 or 10 or 12% return turns into a 22, 25, or 30% return. It's just crazy because the tax savings are driving 50% or more of your ability to do the capital growth. Property development or improvements on property give you great opportunities because you're harvesting the tax attributes. High growth areas, like the areas that we invest in real estate, are high growth transportation corridors, things like that. Here in San Diego, where we can actually go kick the dirt. Market trends and timing. Baby boomer trend is one that we follow. Timing of the market, time in the market. We have a housing shortage right now. If you can get a piece of dirt that can build 6 to 8 units, a developer will pay, $150,000 to $200,000 per door for that land. I just need to go find more land. I mean, it's just a great way to build capital growth and not have as much risk. We'll give you a couple of case studies to look at. And capital growth strategies are inherently very valuable because they give you, at the end of the day, they give you anywhere from a 3 to 10x return. You invest 100,000 and you can get 300,000 on the back end. They are more risk inherent in some sense, but that risk is manageable because you're doing some things. You're looking at a very, very narrow. In other words, I look at a single family in San Diego in terms of how much will it cost to demo and knock it down to dirt, and how many units can I build in replacing a single family with 4 to 8 units. If I can get it for the right price, I know what it's going to cost me to knock it down, and I'll buy it for cash, knock it down, get a permit to do all of that demolition, and then I'll hand that with a pre-drawing analysis from an architect to a developer who can build 8 units and pay me $800,000 for something I paid $500,000, make $300,000 in probably less than 12 months. That's the kind of capital growth strategy that allows you, or even with improvements, flipping properties. A lot of people were into the real estate in the last 10 years doing flips, but I'm going to tell you, the wind has run out of that sail more than because the market contractions that they weren't counting on. But there are some flipping opportunities on multifamily that people are not paying attention to that make really good sense and can be leveraged, where you can come in with like only 5% down. It's just crazy, some of the stuff that you can do. So we'll talk about some of those strategies and how to achieve those in development or improvements. High growth areas and trends. We'll talk about some of those market trends and give you some case studies to look at. And then we'll do a Q&A at the end of that. I think I got one more thing. Also, if you need any help or you want a free evaluation, hit the QR code and get on my calendar, and Alan and myself and our team will be happy to have an appointment, undergo and look at what you've got. What are you trying to accomplish, and where could you maybe do some fine tuning and tweaking of your portfolio? Portfolio management is a big deal. We'll talk about that toward the end of this course because you should be doing evaluation of your real estate portfolio 4 times a year, every quarter. You should be evaluating the performance of your portfolio and making sure that you're staying up with the current economic trends. And if you're not, how are you going to pivot away, particularly because of the uncertainty of the tax aspects? You're not going to be able to manage some of those factors until the year is over. And you don't want to wait that long to be able to make those decisions. All right, with that said, I'm going to take the next 5 minutes if we can and just take any questions. If you've got any questions, be happy to take any questions. And this concludes basically lesson 1 of the course.
I got a quick question, James.
Yeah, go ahead.
Well, it's actually two separate ones. Is there ever a scenario? I know you don't like single families. Is there ever a scenario where they might make sense for anything?
You know, it's such a limited area. I guess for some people that's fine. I mean,
Hmm.
I look at single family for what I could do with that capital in doing a 3 to 5 unit building.
Gotcha.
I just have a preference. It's too much risk. If I can't get a tenant in time, that vacancy factor is a killer on capital.
I see.
And there's so much uncertainty with single family right now because of the housing crunch and pricing. We're seeing prices go so crazy. There's a lot more stability in multifamily. The 2, 3, 4, 5 unit, and maybe the 5 to 8 or 10 unit. There's so much more stability and sustainable growth. Single family is just too volatile and doesn't cash flow.
What about so you guys are all on the West Coast, I'm here in the Midwest. Uh, does any of the strategy change based on the state I'm in?
A little bit in your
Okay.
southern areas, like your southern states, Florida and Georgia, those states, you're seeing because of trends right now, you're seeing the single family market contracting a lot more than it is nationally. Okay.
Gotcha. Yeah.
In the Midwest, in the northern sector of the country, you're seeing properties stay vacant for an unusually long period of time. And that's because people are leaving those states.
Yeah.
They're not tax friendly. And so you have this huge migration away from those states and all this real estate opening up.
Hmm.
Might be a good opportunity to go in and buy, but if you buy it, for 50% on the dollar, but you can't rent it out, you've just got to,
Yeah.
your money's not working, your money's diluting.
Hmm. No, that makes sense. I appreciate it. Thank you.
Yeah. All right. We don't have any other questions. That'll be the conclusion of lesson 1 in this course. And
Hey,
John,
Alan, I have a question.
yeah, go ahead.
So you mentioned as a part of the pro forma, you had to take a look at property taxes that you're being charged.
Right.
And I was wondering if you had any strategies for protesting those. So a few years ago, I had an actual bank appraisal because I was refinancing a property. And I took that to the protest, and their little board overrode it and said, I went with their numbers when I had an actual appraisal that a bank took to loan me money with, and it was only like 20 days old, and that appraised value was a lot lower than what the county had appraised it at. So since then, we shied away from doing any protest. But here recently, all the values have skyrocketed on our properties. And we have a plot of 7 acres. I'm sorry. Did we? Yes, we have a plot of 7 acres. We bought that for $40,000 an acre, and the new value was like at $60,000 an acre. But the acreage around ours were like at $20,000 an acre. So we fought that based on the appraised value of other property or other acreage around us, and actually won that one. So it's too late to do this for our 10 rental units, but we want to get prepared for next year because those values are just way too high just because of what's happening in the market. So I didn't know if you had any strategies or resources for that.
So appraisals are not usually a good source for challenging property tax assessed values. You would want a valuation study as opposed to an appraisal because it's a very different animal. Secondly, you got to make the right argument. And if the property wasn't segregated into asset groups that were classified, then you're not going to be able to make the argument. And here's the argument. It's the rules of obsolescence. And in real estate, there are generally 13 rules of obsolescence that you can apply to the assessed value of real estate by the county tax assessor. You have functional obsolescence, you have manufactured obsolescence, you have all these different rules of obsolescence. If your property wasn't segregated into asset groups, 5-year, 7-year, 15-year, 27.5-year, then you're not going to be able to make the argument that the obsolescence and wear and tear of a depreciating asset should justify a reduction, not an increase in the I do this property tax stuff all the time. I want a $17 million reduction on a Bitcoin mining operation, the largest in North America. I got the property taxes reduced by 17 million and clawed back about $5 million in overpaid property taxes because the methodology that the state was using was incorrect because the Bitcoin mining equipment and the land improvements were not being congruent in terms of how they applied these rules of obsolescence. So fortunate for me, I got a great fee. My fee was $1 million, but they saved 17 million and got back a bunch of money on top of that. And when they sold that new basis became part of that thing. The same thing applies to a rental property. If I can show the county tax assessor that my 5-year equipment is functionally obsolete, the wear and tear has gone down in value, my washers, my dryers, my dishwashers, things like that, I'm going to get a reduction in the assessed value of those improvements because statutorily they have to do that. But if you're not making the right argument or you don't have that basis to make that argument, you're going to get squat. So that's why we do this pro forma analysis and asset classification. Real estate appraisals are valuable for market conditions, but they're not valuable in terms of economic performance. A valuation study is the thing that most investors are now understanding has more value because it gives you all of these other aspects that you can unlock hidden value. And part of that hidden value is reducing the property taxes while you're making more money.
Okay. All right. Thank you so much for that. Yeah, their entire argument is market value, even on this, even on the acreage. And there was like a huge anomaly where like somebody came in and paid millions of dollars for this plot of land. And, Stephen was like, you have to kick that out. Like, I can't even believe that you included that as a part of your study. And so they did kick that out. And, but yeah, that's their entire argument. So I'm glad that there is something else that we can do for next year.
There's a lot of things that you can do if you've got things set up the right way. There's a lot of things that you can do. You can make the argument that wear and tear and obsolescence govern, and it's all in the statute. You got to understand the statutory framework. Every state has a different framework for its property tax assessment and the roles of assessed value. Texas does it one way, Colorado does it another way, California does it completely a different way. So understanding what the statutory framework is, what the rules are, understanding how your property is being presented, it doesn't matter. Market conditions do not matter when you're taking the issue in position of obsolescence, because that's actually defined in the statute in every state. And so every state recognizes it. But if you're not making the right argument, then they're not going to change it.
All right. Thank you, James. Appreciate that.
Yep. All right. Well, I think we've had enough fun for today. We're about 5 minutes over. So John will get this up in the back office, and you'll put the exercise in the back office also, so people have access to that.
Absolutely.
And then again, if you're just watching this and haven't attended live, and you want to get a free consultation and evaluation, hit the QR code, get on my calendar, and be happy to take a look and see if we can find some ways to help. Other than that, have a great day. We'll take care, and we'll talk to everybody in about 2 weeks.